Gold has captivated civilizations for millennia. Its rarity, durability, and inherent beauty have made it a prized possession. Throughout history, gold has served as a universal currency, a symbol of wealth, and a strategic reserve asset for nations. From ancient empires to modern central banks, gold's allure has remained undimmed. Its ability to retain value across generations has cemented its status as a safe haven asset, especially during times of economic uncertainty and geopolitical upheaval. For centuries, nations have stockpiled gold reserves as a form of economic security. These reserves act as a buffer against currency fluctuations, bolster confidence in a country's financial system, and provide a source of liquidity in times of crisis. Gold's enduring value stems from its scarcity, its universal acceptance, and its historical track record as a store of wealth. Even today, central banks around the world continue to hold substantial gold reserves, underscoring its enduring importance in the global financial system. The use of gold as a reserve asset dates back to ancient times. The Roman Empire, for instance, relied heavily on gold coinage to facilitate trade and project its economic power. During the Middle Ages, gold coins played a vital role in international commerce, financing wars, and underpinning the wealth of kingdoms. The discovery of the New World in the 15th century led to a surge in gold production, further solidifying its role as the dominant reserve asset for centuries to come. However, the 20th century witnessed a shift in the global monetary order, with the rise of fiat currencies and the gradual decline of the gold standard. Despite these changes, gold has retained its allure as a safe haven asset, a hedge against inflation, and a key component of central bank reserves. Its historical significance, combined with its unique properties, ensures that gold will continue to play a role in the global financial system for the foreseeable future. The Bretton Woods Agreement of 1944 marked a turning point in the global monetary system. After the devastation of World War II, the world's leading economic powers sought to create a more stable and predictable international financial order. The agreement established a system of fixed exchange rates pegged to the US dollar, which in turn was convertible to gold at a fixed price. This system, known as the Bretton Woods system, aimed to promote international trade, facilitate economic growth, and prevent a recurrence of the destabilizing currency wars that had plagued the interwar period. Under the Bretton Woods system, the US dollar became the world's primary reserve currency, backed by the vast gold reserves held by the United States. This arrangement conferred significant economic and geopolitical advantages on the US, as it effectively gave the country the ability to print the world's reserve currency. The Bretton Woods system ushered in an era of unprecedented economic growth and stability, fostering international trade and investment on an unprecedented scale. However, the Bretton Woods system faced growing challenges in the 1960s. Rising inflation, fueled in part by US government spending on the Vietnam War and social programs, undermined confidence in the dollar's fixed exchange rate to gold. Speculative attacks on the dollar, as investors sought to exchange their dollar holdings for gold, put increasing pressure on US gold reserves. By the early 1970s, the Bretton Woods system had become unsustainable. In 1971, President Richard Nixon announced the end of the dollar's convertibility to gold, effectively dismantling the Bretton Woods system. This decision ushered in an era of floating exchange rates, where the value of currencies is determined by market forces. The collapse of the Bretton Woods system marked a significant shift in the global financial order, with profound implications for the role of gold as a reserve asset. While gold's role as the anchor of the international monetary system had come to an end, it retained its allure as a store of value and a hedge against economic uncertainty. Venezuela, once a prosperous South American nation endowed with vast oil reserves, has been mired in a protracted economic and political crisis for over a decade. The country's economic woes have been exacerbated by a combination of factors, including falling oil prices, government mismanagement, corruption, and international sanctions. The collapse in oil prices, which began in 2014, had a devastating impact on Venezuela's economy, as oil exports account for the lion's share of the country's revenue. The Venezuelan government's response to the economic crisis, which included price controls, currency devaluations, and expropriation of private businesses, further exacerbated the situation. These policies led to hyperinflation, shortages of basic goods, and a collapse in living standards for millions of Venezuelans. The economic crisis has also fueled political instability, as the government of Nicolas Maduro has faced growing opposition and international condemnation. The humanitarian crisis in Venezuela has reached alarming proportions, with millions of citizens facing food insecurity, lack of access to healthcare, and displacement. The United Nations estimates that over 7 million Venezuelans have fled the country since 2015, seeking refuge in neighboring countries and beyond. The crisis has strained the resources of host countries and raised concerns about regional stability. The international community has responded to the Venezuelan crisis with a mixture of sanctions, diplomatic pressure, and humanitarian aid. The United States in particular has imposed a series of sanctions on the Venezuelan government, targeting its oil industry, financial institutions, and key officials. These sanctions have further crippled Venezuela's economy and hampered its ability to access international financial markets. In the midst of a financial crisis, Venezuela made a bold move. They requested the repatriation of their gold reserves from international vaults. However, this request was denied, leading to a tense standoff. The refusal was rooted in political and economic concerns, leaving Venezuela in a precarious position. This denial not only highlighted the complexities of international finance but also underscored the geopolitical tensions at play. International finance is a labyrinthine world filled with intricate regulations and delicate balances. Nations must navigate these waters with care, as missteps can lead to severe repercussions. The case of Venezuela serves as a stark reminder of how interconnected and fragile the global financial system can be. It's a realm where political decisions can have profound economic impacts, and vice versa. Understanding this complex web is crucial for any country looking to maintain stability and growth. The practice of holding gold reserves in foreign vaults is not without controversy. Critics argue that it exposes nations to undue risk, while proponents believe it provides a layer of security and stability. This debate came to the forefront with Venezuela's situation, sparking discussions on the best strategies for safeguarding national wealth. The controversy also shed light on the broader implications of such practices, influencing how other countries approach their own gold reserves. The saga of Venezuela's gold reserves offers several important lessons. First, it highlights the significance of maintaining good international relations. Second, it underscores the importance of having a diversified strategy for national reserves. And finally, it illustrates the potential pitfalls of relying too heavily on foreign-held assets. As countries around the world reflect on Venezuela's experience, they are reminded of the delicate balance required to manage and protect their national wealth effectively.